Welcome to Nerd Stock Talk. This is our Saturday night. Thank you for everybody joining us. Saturday night, 8 p.m. So be there. Come on in. Enjoy the chat. Do whatever you want. We're here to entertain you, as I said in that disclaimer. And with us here is JP Diamond Hands Wildman, and our Mike is out this week, so he's probably.
I don't think he stopped crying from his losses from the week before. That was a hard time with the GameStop drop.
It's true, and it's dropping. And we could talk briefly about that was on the news as well. As there was a congressional financing, and I don't know if we can ask you about that as well. But first, let's jump into how did our stocks do last week? So. Well, we'll start off by looking at who the biggest. We start off with who lost the most, middle, and gold. So once again, 2 weeks in the running. We're just gonna, since Mike's not here to defend himself, Mike did say his last week's pick was Sensonics. Wasn't that bad.
Sensonics was looking pretty good midweek.
Yeah,
there was that sell off on Thursday that really turned the tables quite a bit on a lot of stocks.
That's true. And then he also said Blackberry. He was like, was it Volkswagen? He said was making a deal with Blackberry to.
Yeah, which would put the target price for Blackberry if Volkswagen inked the deal at about $8.
Yeah,
I think it's trading at like 12 now. So
yeah, it's still.
So he's still got some
market correction,
mud to wade through.
and I think, but he said though Blackberry is his long-term pick, I think, and he said, I think that was, if I recall correctly, he was both of them are kind of long-term picks.
That's probably a good move.
Yeah, and he did have Apple, but I didn't put it on there, and Apple lost as well. So, and second place would be me, Tencent. Still, I mean, not too bad. Tencent, as I say, that's my long-term pick. That's the one I'm going to keep my money in. I don't think that's my never sell. I'm going to keep that one. I have a lot of confidence in that one. And Activision Blizzard, I mentioned that BlizzCon line was coming out. I got the dates wrong. It did come out. It came out on Friday and Saturday. So today it's its last day of it. So I was predicting it was going to be on like a Tuesday or a Wednesday that they're going to have that event, so we were going to see a jump. So I still think we might see a jump in the price, but I think these come down with that. As I say, it was a really bad week for the stock market anyway.
Yeah,
this past week. So
one of the worst weeks this year.
Yep, I think that's what they said. Yep, but for some reason though, your picks. CBAK was up. That's really volatile, though, right? You want to talk to us?
It is. It's getting less so. It's really starting to form a really solid trend line, and I am actually considering reorganizing my portfolio a bit and jumping into that. I have a target of that one for $20 by the summertime.
Wow. Okay.
I think that's really gonna continue this trend line.
Right. Okay. And talk to us about, you were telling us last week you're going to try something out with this S&P 500 ETF.
Yep.
And talk to us about your experiment.
So it was working. Beginning of the week, I would be up. What I would do is I would buy the stock just before the market closed. This is an ETF that tracks the S&P 500. So it's an ETF that's comprised of, and I think we'll talk more about what an ETF actually is later, but it's comprised of all of the stocks that are listed on the S&P 500.
Right.
So I buy this. I just bought one share. It's about $390 or something. It floats in that area right now. I buy one share at closing. Mm-hmm. Maybe half an hour before closing, depending on how busy I am at the time. I put the order in, buy the share, and then after market closes, I put an order in to sell. So as soon as the opening bell, an order goes in to sell at market price, and there it is. And someone did a study on it, and the share always goes up far more overnight than it does on average during the day. So at closing bell, between closing bell to open, it rose over the course of the year. If you had done that last year, you would be up 571%.
Wow. Okay.
Whereas the S&P 500 itself was only up, 10 or 20% or whatever the figure was. So it was a significant difference.
Right.
And the only trouble with doing this is just, remembering that at, 4:30, you've got to put that order in to buy and get that stock in your portfolio. Otherwise you miss the boat. So that's the tough part. Is there some daily reminders? I had some alarms set on my phone and such. 4 o'clock's a busy time of the workday for me. So it's hard to, pull myself away and make sure that order goes in. But I pulled it off. I did skip Thursday when the market was down significantly. I just decided that I might as well hold on at this point because it can only go up. I ended up selling mid-afternoon for, I was like probably 11 o'clock. I ended up selling and I was only down about 2%. So.
And what, as you're saying, we were just talking earlier that as you mentioned, that it was a pretty bad week for investing. And
yeah, the market has been going up far too high for far too long. And any sort of, we had some, I wouldn't even say bad numbers for the job market report. They were just not as expected. And it seemed like the market was just looking for any reason to sell and make a correction. So we probably have a few more of those in store before things really start to fly again.
Right. And I know people always talk about different types of investors as the idea of buying the dip. So the certain stocks that if you're a fan of, as we talked in every episode, and just we always want to remind people is that what you're passionate about, you probably already have a lot of knowledge about. So whether it be video games, books, publishing companies, entertainment industries, whatever that thing that you're passionate about, cars, whatever it is that, and you think, hey, this, I kind of want to get on this. This is when the prices go down, it's a good time to buy. So I was just having a conversation with someone today about that. They tend to look at the stocks that are in the green when they're looking for something to buy. Yeah. And that's actually the opposite of what you want to do. You want to look at stocks that are in the red, significantly in the red. If you're looking at a stock that's declined by 20%, chances are it's going to return back to more of a mean unless there's a really good reason, if they filed bankruptcy or something like that. Yes. But if the stock is in the red on no real news by a significant amount, chances are it's going to return back to that daily moving average that we've talked about in a few previous episodes at some point. So when a stock is down 20%, that's an opportunity to make 20% in the short-term future. So that's right. And as I say, like everybody, everybody's a nerd in their own sense and what it is, whether it be a coffee nerd or they're a music nerd or whatever it is. So look at that. Like if you're a fan of Starbucks, do you have faith in that company? And then what that JP said, look at their stats, look at how their stock's been up and down a bit and see if there's a good time to get in on that. So, but yeah. So with that said, I know we want to talk a bit about, you have something you want to share with us. Our topic for tonight is options. I really want to learn more about this. This is is some high grade stuff. This is not your average stock stuff. So I would tell anybody what JP is going to talk to us about. This isn't your introductory to thing. This is just going to give you a frame of reference that it's not just there. You have different ideas. You can either sit down and buy a stock if you want to of something that you really like that we've always been talking about. But here's a different approach to it, which is called options. And what I want to do then is, JP, is hand the baton over to you, and you want to give us a kind of an introduction on what options are?
Yeah, sure. This is a great way to lose all your money really quickly. I don't know if you can see my screen, but
here we go.
I'm logged into Robinhood to the options screen. If you have a subscription to Robinhood, if you're a gold member, you can open up options. You have to have margin enabled because you can lose so much money in options. But hopefully after a few pointers here, I can tell you how not to lose so much money. The thing with options is what you're buying is a sales contract. You're not actually buying the stock. And they come in blocks of 100. So this is Ford Motor Company, currently at $11.56. Up here, you can buy a call, you can sell a call, you can buy a put, or you can sell a put. Now, the difference between a put and a call is an option to buy a stock. A put is an obligation. So if I own 100 shares of Ford and I want to make sure that the price I have right now, $11.56, is locked in, I can buy a put, okay? And I can say I can pay 96 cents per share, and for $202, I can ensure that I will be able to sell my shares on April 1st for $12 a share. And that's kind of a way to protect my investment. Now,
okay,
if the shares are $11, I haven't really made money. I've saved money. If they're $10, I've saved even more money, because you still have this cost of the option to cover. And conversely, with selling a call, if I own 100 shares of Ford at $11.56, I can sell a call that expires on April 1st for, let's say, $13.50. I will get paid. I don't know why that's not changing. I will get paid $101 for selling that call.
And how much did you put into it?
Nothing. I have to own the shares.
Oh, okay.
So you have to own 100 shares of Ford in order to sell a call, or 100 shares of whatever it is you're selling.
Okay.
And you will get paid $101, the cost of that option. The only thing is if, so $13.50, that means the share price has to be $13.70 for whoever bought that call to make money.
Okay.
So if the shares don't go to $13.70, I've just made $101, and I get to keep my shares. If they go to $14, then I am going to have those shares called away. In theory, I will have already made money, so it's not too big of a deal.
Right.
And I can just turn around and take the premium that I got, plus the money I got paid for my shares, and buy the shares back. And I'm not really out a thing. Buying a call, that's where things get a little weird. So we see the price is $11.56. I can say, see here, here's the dates that the options expire. They expire every Friday. We'll go to June 18th. And let's say on June 18th, you can see I already have a few $12 options for Ford on June 18th. Okay. But let's be a little more risky here. See up here for $20, a $20 strike price. It costs 15 cents per share. Okay. So let's add that. I don't know what is going on here.
Because maybe you already have shares in it. Do you want to try one that you don't have something in?
There we go. 15 cents
Okay.
this year. So, okay. $20. So we're saying on June 18th, actually, we don't even have to think that Ford is going to be $20 on June 18th. All we have to do is think that Ford is going to move up from this price of $11.56. If Ford goes to $12 between now and June 18th, this option that I paid 15 cents for might be now worth 30.
So you're locking yourself in now.
You're locking yourself in now, but I can sell this option at any time. I don't have to wait until the expiration.
Okay.
So if Ford goes up to $12 tomorrow, the cost of that option is going to go up to maybe 20 cents. And I will have made 20 cents times 100 So $200. This is where options become really, really lucrative. There's leverage involved there. Because you're buying 100, you're buying the
promise or
100 shares. Yeah,
right.
The benefit of 100 shares. So if you buy this option here at 15 cents, it's going to cost you $15. Come June 18th, if Ford is $30, I can buy Ford for $20 and make $10 a share, and you've cleared $1,000 on that share.
So would you say that, if looking at options like something like this, would you say that part of it would be like, for me personally, like if I was, we talked about it last week about kind of like having me dabble into some options, but it would benefit me to do that with companies that I know about, basically.
But yeah. I mean, it's you want to have a very good understanding of where of the company.
Right.
If it's a company you own shares in now and you're really familiar with the price movements, you've kind of been following it, and you have a really good idea that next month it's going to be up another $1, then that's a great way to leverage your capital, because you can, rather than dumping your capital into 100 shares to make $100 when that goes up, you can dump that same amount of money into options that are a tenth of the price and actually end up with the same benefit as owning 1,000 shares, 10 times as many shares as if you bought it. The downside is that options deteriorate over time. So we'll take a look at these numbers here. They're called the Greeks. The delta, the gamma, the theta, the vega, and the rho. The delta is the amount of money that this option price will increase for every $1 the stock price increases.
Okay.
So if Ford goes up to $12.56, the price of this option is going to go up 9 cents.
Okay.
So it'll be 24 cents. So if this goes up to $12.56, this is now worth $24. Gamma is the velocity. It's kind of it's plays off implied volatility as well as vega. These two influence the delta. So the more the stock changes, the more this implied volatility goes up, the bigger the swings, the higher this gamma and vega number are, and that will influence the delta. So that means that this price of the option will swing wildly. You might wake up one day and it's worth a penny, and you might wake up the next day and it's worth $1. In which case you have made a pile of money, or you have lost a pile of money really quickly.
Right.
More importantly, theta. Theta is time. So you see that's a negative number. So every day that goes by, this option becomes 0.02 of a cent, worth 0.02 of a cent less. That option also, or that number also changes with the gamma and the vega as things go. Rho is based on interest rates and that sort of thing. That also plays a factor in these other Greeks, which play into the final price of the option.
Okay.
We take a look down here, these more expensive options. So this option is called out of the money, meaning it would not be worth anything at expiration. The safe way to play an option is to buy an option that's in the money.
Okay.
You can see here our share price is $11.56. So if we bought an option that was $1, you can see it's in the money. To break even, the share price needs to be $11.50. Now you can see the price of that is way high. This would be the equivalent of spending the same money as buying 100 shares. However, when you look at the Greeks, actually that's in the money, so it's 0. You look at the Greeks, they're a lot higher for options that are in the money. So if this underlying price goes to $12.50, this goes up to $2.10. It goes up 62 cents. So that's where you can, and all these numbers are times 10. So when you buy that option, you're times 10, $173. Not the $1.73. We got this one selected too. So you're $158 for this option. And that gives you the option to buy 100 shares on June 18th for $11. Then you see the break-even price. The break-even price is this plus the share price.
So for instance, picking like a safe bet but further out, can you do a safe bet plus further out as well?
Well, that's where, yes. So if I wanted to gamble a little bit, this isn't a lot of money, $15.
Right.
You could gamble on that. And if Ford goes up $2 or $3 between now and June, this $15 is going to become $45. Now, where you really want to get risky is you could change that to 100.
Right.
Okay, so you change that to $1,500. If it goes up to 20 cents, this becomes $2,000. If it goes up to 50 cents, this becomes $5,000. So you can see where that leverage really starts to bring you some really fat returns really quickly. And It doesn't have to reach $20. So long as you don't wait till these Greeks zero out, like to hear, you'll be okay. So you'd want to sell this well before June 18th. Especially if it's in the money. You might want to sell it sometime in April if it changes to 25 cents. And you might be losing out on some wins, but you're locking in your gains.
Right. Okay. Cool. All right. So I think this is so ultimately for our listeners and viewers out there, this is just as kind of an introduction that it's not just buying stocks. There's different ways out there. The options is kind of a higher level when it comes to that stuff, but if you play it safe. Don't get too expensive. If you buy a stock that's in the money, you're okay. It's more expensive to lay that money out, but you're guaranteed not to lose anything so long as the stock doesn't go down. If you want to really gamble, do the options that are the furthest out for the most money. Those are called leaps. They're very inexpensive, and what you're playing on is just the value of that moving up a little bit. You're really not expecting the stock to be worth what the strike price is, but you're hoping that maybe the value of that will double in the next month, and you can unload it before then and make a little money. $15, you're out $15 if it doesn't work out. You're not out $1,500. Right.
That's the thing with the options is that they deteriorate over time, and the biggest mistake is waiting too long. If you can be up 150% in an option overnight, and oftentimes the next day you will be back down to zero and it might never return. So if you are up a significant percentage in an option, it's best to just unload it unless you have some pretty good confidence that your positions are going to be in the money at expiration.
Right.
And then when expiration comes, you can exercise that option and buy the underlying shares and immediately sell them and make money again.
Okay. So let's get on to our final topic, which is what are you looking at for next week?
I am looking at Butterfly.
Butterfly. Okay.
Butterfly is a handheld sonogram for doctors that works with a smartphone, and it's every bit as good as the sonograms you find in a hospital.
Wow. Okay.
It's extremely inexpensive and can be used anywhere in the world, third world countries, whatever. It's app based on a smartphone, and this is a stock that was just put into the ARK ETF, the Transformative Technology, Disruptive Technologies ETF, because this thing really replaces the $50,000 sonogram machines in hospitals and does a better job at it. Everything's in high definition, and
wow.
You email the photos, and it's a really cool thing. The stock price is right now around $20, and I think it has a target of around 150.
Wow. Okay. Huh. And and you mentioned ARK ETFs. So I discovered ARK ETFs this past week. So it's still my long-term. Is your long-term still Canoe? Yeah. I'm still in Canoe. Okay. Yeah. As I said, my long-term is still Tencent, and I'm checking out right now. I have that. So, and we'll talk about next week. We'll talk about what ETFs are. So that's going to be a fun topic, the difference between mutual funds, index funds, and ETFs. That'll be a good topic that we can talk about. And I have some money into, I think, 2 ARK ETFs right now. One was the lesser expensive one because it was, and that one I have money in the ARK FinTech Innovation. I have that one is I'm going to be watching, and then the ARK Innovation ETF that you just mentioned. I think, is that the one that has the butterfly in? I'm not sure if it's the innovation or if it's the transformative technology ETF. Okay. The transformative technology is the one I have. Right. That's a lot of electric cars, wireless charging, some drone technology companies in there. SpaceX is in there. So that's the one I think has all of the ARK ETFs are posed for some really good growth, but right. The transformative technology I think has the potential to 10x or 20x, which is what I'm. It is all future oriented, and we already talked about this. Is like I love looking at those ARK ETFs. So what we'll do? So maybe we'll do for next week. We'll talk about all the ARK ETFs. Maybe we can talk about that. Yep. They are super fun. Like it is basically like science fiction level stuff that it really is. There's some crazy like you look into it and there's actual companies doing this. This is some Star Trek stuff. This is cyberpunk, like science fiction Blade Runner stuff that these ETFs are. So these exchange what was that exchange trade? What are they called? ETF? Exchange traded funds. Exchange traded funds. Yeah. So anyone watching or listening, check out ARK, ARK, and then they have a bunch of these exchange trade funds that they've kind of bundled up together, and an ETF basically is a combination of different stocks put together. Yeah. So basically, the difference between stocks and ETFs is that it's any of those index funds is that stocks is like you're going to a buffet, you go into those Chinese buffets and you just stick into Kung Pao chicken. I'm just going to eat Kung Pao chicken. I've never not liked Kung Pao chicken, so I'm just going to stick with Kung Pao chicken. Where like an index fund is basically it's your whole buffet. You just put everything on your plate. A little bit of everything. Yeah. A little bit of everything. So, but great. So the nice thing about that is that there's always something in there that's really, really good that offsets the stuff that's not so great. Right. You're thinking, I am going to go for the chicken and broccoli because there's broccoli in there. So it must be healthy for you. I just going to have to have some green on my plate, but you're really interested in the crab rangoon. That's the thing you kind of like put on there. So thank you very much, everybody. And this has been another episode of Chinese Buffet is Just a Stock Market. No, I'm kidding. And we do have, I do want to do pull up. So we do have, if anybody's interested, questions, comments, or hygiene tips, please send them to nerdstocktalk@storycomic.com. And we will post your questions on the air. All right. Well, thank you very much, everybody. And we will see you, see you next week.